All right, office fans, let's practice our corporate concepts and our partnership concepts as they relate to S corporations, which, as we discussed, are a hybrid of both of those business ownership forms. We're going to illustrate these concepts using Athlead, which in season 9 of The Office is a sports marketing company that Jim Halpert and his college friends founded. We assume that they went with an S Corp status because it does provide them with those hybrid benefits. An Athlead is a calendar year company. Jim's initial investment is $10,000 cash, which he did not ask his wife Pam about before he made the investment. So let's explore. In the first year of its formation, Jim's $10,000 stock purchase comprised 20% of Athlead's stock for the first 304 days of the year. On November 1st, Athlead admitted another shareholder, which reduced Jim's ownership percentage for the remaining 61 days of the year. What is Jim's share of the following items? Ordinary income of 50 grand, charitable contributions of 5 grand, and tax-exempt interest of $500. Remember, the formula for calculating shareholder percentage is the S corporation item multiplied by the percentage of shares owned multiplied by the percentage of the year that the shares were owned. This is why it was so important that each of the shares had the same value and rights and everything, and only one class of shares to make this math possible. So we'll compute it for the ordinary income. I'll show you what the calculation would look like for charitable contributions and tax-exempt interest, but I'll leave you to calculate those on your own. So for the first 10 months of the year, Jim owned 20% of the shares for 304 days out of the year, so the first 10 months, which yields, when you multiply those three numbers together, around $8,300. In the last 2 months of the year, we'd still take the same ordinary income amount because that's for the whole year. We'd multiply it by Jim's percentage of shares owned and the percentage of the year that he held that level of ownership, which would yield a reportable amount of around $1,250. The amount that would transfer over to Jim's income tax return is the sum of those two numbers. Computing charitable contributions, you would use the exact same share ownership percentage and year percentages. The only thing you would swap out is the partnership item, the S Corp item, which in this case is $5,000. Same applies for the tax-exempt interest. So now let's look at distributions to S Corp shareholders. The math is easy if the S corporation was never a C corporation. And let's assume that that's true. Luckily for Jim, since he made an investment without asking his wife Pam first, the corporation has been successful at developing shared athlete and marketing partnerships. In its first year of operations, it's able to make cash distributions of $20,000 to each of its partner shareholders. If the basis of Jim's shares is $10,000, which is what he kicked in from his own savings, what is his ordinary income from the distribution? What is his capital gain from the distribution? And what is the basis of his shares following the distribution? Let's take a look at each of those. What is his ordinary income from the distribution? It's $0. Why? Because it's a tax-free return of capital. We assume that he's getting back what he invested in the company, so that's $0. He already put the money in. He's not going to get taxed on money that was his in the first place. What about the capital gain? The capital gain is $10,000. The amount of Jim's distribution less Jim's basis in the corporation. So $20,000 less $10,000. What are his shares worth for tax purposes after the distribution? They're worth nothing. You compute that as the reduction in Jim's basis, so the $10,000 that you saw in line 2, minus Jim's original basis. Everything above that is capital gain and taxed at the capital gain rate. His shares are worth 0 as the S Corp does more business in the following years, and the income gets earned but not distributed. That would boost up Jim's basis. All right. That gets a little tricky when S Corps were C Corps. And if you watch the show The Office, you know that Athlete eventually became Athleap and was bought out by Converse. So for the sake of this example, let's say that Converse decides to spin Athleap off again. The original partners decide to continue doing business as Athleap. But they've got the Converse money to go with it. So we're assuming that Athleap is making Converse-sized distributions to its shareholders, and Jim's distributive share is $150,000. It's been a good couple of years, especially under Converse's leadership. Jim's stock basis is up to $200,000. The corporation itself possesses AAA, which is the adjusted account of $80,000, and accumulated earnings and profits from when it was a C corporation of $25,000. So let's look at how this impacts the distribution itself, the effect of distributions on Jim's basis, and what the account balances are after each of those distributions. So distributions, we know that the AAA account has $80,000 currently. The accumulated earning and profits account has $25,000. And Jim has a stock basis of $200,000. Jim is receiving a Converse-sized distribution of $150,000. So when it comes time to make the distribution, we take the first 80 grand from the AAA account, the next 25 grand from the AEP account, and the remainder from Jim's stock basis. So 45 grand, which is what's left over. AAA distributions are considered a tax-free return of basis. So that decreases Jim's basis in his stock by 80 grand. AEP is considered a corporate dividend, so it doesn't impact Jim's basis, but he does have to pay taxes at the capital gains rate on that distribution. And finally, the remainder that comes out of Jim's stock basis is a reduction of basis, and it doesn't have tax consequences. So what are the balances after the distribution? The AAA account and the AEP account both have 0. We've wiped them out to pay Jim. Jim's stock basis is 75 grand. The difference between his original $200,000 and the 2 distributions from his basis. But what would happen if they had incurred a loss? That after Athleap goes back to doing business on its own without Converse's backing, it's not as profitable as it was with Converse's backing. In this scenario, it's operating as an S Corp. It suffered a loss of $75,000. And given the loss, Jim's distributive share is 50 grand instead of the 150 grand. What then? So we start again with the beginning balances of the AAA account and the AEP account. We plan to distribute to Jim 50 grand, and the company incurred a loss of 75 grand. So we know from the order of distributions that Jim's 50 grand comes out of the AAA first, and there's no impact to the AEP. The loss is deducted next, with no impact to the AEP. This leaves an ending balance in the AAA account of 45 grand in the hole, and a balance in the AEP account of 25 grand. Now, why aren't we touching Jim's basis with the loss? The answer is we're not doing it yet. In the long run, the company's loss will get passed through to the partners. So it'll impact Jim eventually, just not right now. What about that 45 grand in the AAA account? What then? For now, nothing. It's got a negative balance, and the partners can't do anything with it. They can't make distributions from the AAA account until they've restored it from profitable operations and the other transactions that we talked about in the concept lecture. Now, what if the shareholders unanimously decided to draw from the accumulated earnings and profit account first, which is allowable under the tax law? In that scenario, we'd start by deducting Jim's distribution, 25 grand first from the AEP, 25 grand from the AAA account. Then we deduct the loss from the AAA account, and this would leave an ending balance in the AEP account of 0 and an ending balance in the AAA account of negative $20,000. Jim's stock basis would as yet be untouched because, as we established, the loss gets distributed last. It gets passed through to the partners. And then the loss is lesser in this scenario, making that option a potentially better option because it simplifies future math by eliminating the AEP that were carried over from when Athleap was a corporation. And it also reduces the loss that the corporation has to bear and pass on in the future. You should have all the tools you need now to compute your homework problems. As always, feel free to email me or message me on Moodle if you need any help. I'm here for you. Thanks and happy homework.